Hi, Anthony.
Hi, good evening, Jeb.
How are you doing?
Well, and yourself?
I'm good, thanks.
Great, yeah. So, did you have a chance to look at the second question
I,
from?
I tried to, but I was having issues because I didn't have it printed out because I work from home today. It was quite difficult trying to get all the stuff in it. But what I did, and I had quite a hectic day at work. So what I did manage to do is I got through about 20 of the questions on the multiple choice on the second exam.
Okay, yeah. We'll start with the
The question
long
two.
question. Yeah, we still need to
Okay.
finish off the May June 2017. So, if you had a chance to do some of it, that's great. You'll see, obviously, they split it into three sections again.
Yeah, I was battling trying to break up the stuff. I kept having some issues with my PC. It kept freezing.
Oh, okay, all right. So, yeah. Besides the technical problems, did you understand what the focus was in the question? Like, we've got it here in front of you. Actually, I've shared
Yeah.
the screen, so you should be able to see it as well.
Yeah.
Okay, so we're looking at May, June 2017. We're obviously continuing where we left off last time. Obviously, question two is long. They give you a lot of information. Again, in terms of tips, in terms of exam technique, I would always
Yeah.
look at this, the required, just to get an idea of what they're asking you to calculate. So the first one is asking about this, operating leverage. Operating leverage is a formula. You're going to obviously have to write it down and you're going to have to calculate it. The nice thing about this is they've actually given you the DOL.
Okay. Yes.
They've given you the
Okay.
percentage change in EBIT over the percentage change in sales.
Sales. Okay. Cool.
There is another formula for DOL. It's in the notes. I'll refer to it later as well. You can use either or to calculate the degree of operating leverage. Just to give you some background information, operating
Yeah.
leverage is looking at this, the sales and the EBIT. We're
Yeah.
looking at how effective are we in terms of operations in generating profit, but profit before interest and tax. That's
Yeah.
the important bit.
So,
So
so
obviously, certain businesses are more operationally effective from a cost point of view because they may raise more profits in terms of EBIT than another business. For example, we might be able to generate 3 Rand for every 1 Rand worth of sales in terms of
Yeah.
profit. That's a really good business compared
Yeah.
to one that's 1 to 1. Right, so
Yeah.
1 Rand worth of profit to 1 Rand worth of sales.
okay. Cool. Yeah. I actually looked through. I looked through the leverage stuff, the financial leverage, and the total leverage stuff.
Okay, good.
Yeah. So I know that the other one is total contribution margin divided by net profit, and then you've got one that basically takes the quantity and the costs over the quantity and the costs with the full costs. Well, variable costs and then full costs.
Well, it depends, yeah. Remember, there are different equations for leverage. I would stick to the ones that are in the last set of notes, the ones that summarize all of it. So maybe just to show that quickly, that was the separate set, which was this one, support material 7, which was the revision weeks slides. In that set of notes, leverage starts here, and you'll see with leverage, it's broken up into different sections. The first is obviously break-even point.
Even point? Yeah.
Okay, break-even point, we actually saw a question,
Yeah. We did a bit of that last night. Yeah.
yes, with the fixed costs and the SP minus the VC. So that we've covered. Then we've obviously got this, which is the operating leverage. This is what the actual exam paper has given you. But you would have to
The other
study
one at the base
these
level, yeah.
equations because you may have to calculate the actual DOL. You were fortunate in this past paper to have been given the formula, well, this formula. This
Yeah.
one wasn't given. You could use it if you wanted to work out the DOL. It doesn't matter what formula you use. This is
But the
just using the
DTL
income statements.
formula, the second formula for DTL is exactly the same as the DOL.
The D, what do you mean?
The degree of total leverage.
Yeah, the degree of total leverage, it's not exactly the same. If you look at it, the DTL, here's degree of total leverage.
There, but the second one is exactly the same as. Oh no, it's not.
Here's DTL.
Yeah. Okay.
DTL takes your DOL, so your operating leverage and your financial leverage, and it combines the two. Okay, because leverage is looking at how much can you generate in terms of profit based on your operations, and based on your chosen form of finance.
Okay, perfect.
Okay, and obviously we've got two separate equations. So DFL is here, that's the formula. But if you take the two and you combine them, then you get that one.
Yeah, okay, cool. I don't know, I obviously wrote something down a little bit wrong somewhere in my notes.
So 2.1 says calculate the company's DOL from 2007 to 2008. And they're wanting you to use this table. So this table needs to be recreated, and obviously we need to fill in the blanks. Right, so sales in units, then sales, variable cost, fixed cost, and so on. So I'm going to create that here on the actual PowerPoint. Not PowerPoint, Excel. Let's put sales in units.
Yeah.
And then EBRT. Okay, so what do we need to work out? Well, the DOL. Right, you can see here in the actual question, let's go back, that DOL is the change in the EBRT over the change in the sales. So we'd be looking at those two line items.
Yeah, cool.
Right, and then you're obviously trying to get the DOL. So you have to create this table, or recreate the table and find the right values. Right, so let's go to the information, let's read through it. Question 2, 25 marks, it's a lot. Long questions count a lot more than the multiple choice. This is May, June 2007. That was what we were given here. And you've been given the sales for the past 2 years. Okay, we're obviously looking at 2017 to 18. That's what the question asked for.
Okay.
This isn't 2017 and 18. This was 2015 and 16. Although the market for JoJo tanks has been expanding, D-Limited could not share in the growth due to technical problems experienced with the current machine. To increase its production and sales, the company is considering replacing the current injection molding machine. Okay, again, this is looking at that whole idea of replacing equipment in order to improve operations. And that'll cost the company $300,000. The outlay will be offset partially by the sale of the old machine. Okay, so again, it's new and old. They talk about the old machine having cost $200,000 2 years ago and can be sold for $100,000 before tax. The lifespan of the old machine was originally 6 years, and depreciation is calculated on a straight line basis. Okay, that's just old. Then that's new.
Yeah.
As a result of the acquisition, the new machine sales are expected to increase by 5,000 units per year from 17 to 19, and to stabilize in the following 2 years, 2020 to 21. The 2016 sales price per unit was 20 Rand. Okay, that's important because now we can actually calculate what the sales are in 2017. We know that the units are going to be expanding by 5,000 units per year in 17 and 18 and 19. We know that the current sales price in 2016 was 20 Rand per unit. And we know that there's an increase in inflation of 6% annually. The new injection molding machine will be depreciated on a straight line basis over 5 years and will be terminated and sold at the end of the 5th year at a scrap value of 90,000. Again, that's looking at the assets. Then you've got the company selling the tanks, 25,000 tanks in 2016. Right, that you could have worked out. Why? We've got this, the total sales, and we've got the price.
Yeah.
So if you take 500,000 and you divide that by 20 Rand, you're going to get 25,000 tanks.
Yeah.
Okay, so they didn't have to give that to you, but they did, which is fine. If they didn't, you would have to show that working.
Okay.
They tell us the total fixed operating costs were 120,000. The fixed costs, including depreciation. Including means they've already taken that into consideration.
Yeah.
Will be constant for the next 5 years at a variable cost per unit of 5 Rand. As a result of purchasing the new machine, management expects cash to increase by 20,000. That's cash flow. Then they talk about the accounts receivable, they talk about inventory, and they talk about accounts payable. That's your net working capital. That's what you should be thinking about when you read something like that.
Okay, cool. So the R5 and the R5's constant, eh? The variable cost.
Yeah, that's what they said.
Yeah. Okay.
Then they said the company intends to finance the replacement of the machine as follows. Right, so obviously this is looking at the financing decision.
Yeah, cool.
3 forms of
100%.
finance: debt, pref shares, and ordinary shares.
Okay.
This is looking at the dividends, and then they
Yeah.
say management of D wants to maintain the present equity, debt, and preference share in terms of capital structure. That's important
Yeah.
because that tells you how much you've got.
Okay.
Tax 29%. Right, so now you've gone through the information, you've got a pretty good idea of what's been given in the question. That's the right exam technique. So basically, give yourself a, let's say, high-level view of what the question is covering. So now I've got a really good idea of what's happening. I know this business is obviously struggling to make sales. I know they're wanting to buy a new machine. If they buy a new machine, it's going to impact the sales. They obviously have to raise capital. Capital is going to come from 3 forms of finance. That's going to be used to buy the new machine. Okay, so that's the general summary of the scenario. All I need to do now is complete the table. Right, so let's go back and let's start filling in things that we know. Okay, so obviously we need 2 years here. I'm going to put 3 years because they gave you 2016 as well.
Yeah. Okay. And that's where we get the change from.
Yes, okay, so sales in units in 2016 was 25,000, given in the question. Okay, no working required there.
Okay.
They wanted the sales rand amount in 2017 and 2018, and we know that the quantity is increasing. Where was that? Let's go back and highlight it. Here's it. Right, so 5,000 units per year for those 3 years, 17, 18, and 19. So that means the quantity is going to go up, and the sale price is going to increase.
Yeah. Yeah. Just busy working that out.
I'm going to add a line here for price. Price in 2016 was 20 Rand. If it goes up by 6%, we're going to times it by 1.06. If it goes up by another 6%, we're going to times it by another 1.06. That's the selling price. In terms of units, the units go up by 5,000 every year. Add 5,000 every year.
Yeah.
Right, so how do I get the sales? Simple. Sales in units times the selling price. Does that make sense?
Yeah. I'm just busy working it out quickly. Okay, yeah, so I've got 636 for sales in the first year. I've got exactly that.
Great. Okay, so now we need to put in the fixed and the variable costs. In order to do that, go back to the question, reread, and pull out the information that's required.
120 was the fixed cost.
Okay,
and
yes. They tell you that the fixed costs are 120, but notice, including depreciation.
Okay.
Including depreciation. Including means what? They've already taken that into consideration.
Yeah.
Right, then they say it'll be constant for the next 5 years, and the unit cost is 5 Rand per unit. So we can put that in.
Okay, so what do we do with the depreciation then?
Yeah, we'll discuss that just now. Let's just put in the final amount here. Variable costs, units times 5 Rand. Okay, so if I'm looking at the accounting calculation for EBIT, is the accountant going to take depreciation into consideration?
No.
Yes, they will.
Will they?
Yes, they will, definitely. Alright, when working out EBIT, accountants will include the depreciation, right?
Yeah,
Definitely.
100%.
Okay, because accountants will take that into consideration when doing the calculation. Right, so has that been taken into consideration?
So we don't need to make any adjustments for it then.
Exactly. Okay, so sales, less fixed costs, less variable.
Yeah.
Gives you that. Makes sense?
Yeah.
Okay, now we need to use the DOL equation, because that's what the formula was in the actual information here, because they said use the table. So therefore, now we need to work out DOL. Degree of operating leverage is a percentage change in EBIT over a percentage change in sales. Okay, so I'm going to take that from our notes. DOL, let me just copy the right equation, this one. Go back to our Excel spreadsheet, let's paste it. DOL. Alright, so how am I going to get the percentage change in EBIT? Easy. I need to look at the amount that I've calculated. Alright, so you're going to type 491,520 minus 366,000. Okay, if you want a percentage, you're going to have to put that in brackets.
Yeah.
Then you're going to have to divide that by what it was before, which was 366, and then times it by 100 to get a percentage.
Okay.
And then you'd have to do the same thing for the sales, but with the sales figures. So sales were 786,520.
Would you not round the rand up in the 2018 note to 22.48 or 22.47?
What, the selling price?
Yeah, because I mean you can't sell something at 22.472.
Yeah, that's fine, but I mean I'm not going to round off anything. I'll round off the answers. I won't round off the workings, because if I round off workings, your answer might be out.
Yeah. But I mean that's because I'll just use 2.47, and I mean it makes about a 70 rand. It makes about a 70 rand difference in the sales price.
Yeah, so don't use.
So in what the actual sales is.
You use the amount as is. Round off answers, don't round off workings.
Okay.
Okay. All right. So that's the change. Change in EBIT. That's the working for it.
Okay.
Then just get an answer. Right, 1.44.
Okay. But now wouldn't the degree of leverage wouldn't have 2016 have something to do with it either? Because I mean, surely that's got to contribute to the change.
No, 2016 is 2016. You're looking at the DOL from 2017 to 2018.
Okay.
Okay, so you're only looking at those numbers there. You're looking at a change in EBIT on this side compared to a change in EBIT on that side, in relation to the change in sales on this side versus the change in sales there.
Okay.
Okay, so you're only looking at those 2 years. That's why you had to draw up that table.
Yeah. Okay.
Right, and that's the answer to the question.
Okay. Cool. Yeah, I've got this. I understand this quite a bit.
Good. Okay, that was out of 10 marks. You completed the table. Did they ask you to comment? No, they didn't, so that's fine. 2.1 is complete. 2.2, calculate the company's costs of capital, okay, for each of the different components. That's an important one because we're looking at the financing. Right, so earlier when we read the scenario, we already saw that there were 3 forms of finance.
Yeah.
Right, so I'm basically doing a cost of capital calculation for each of these.
Okay.
Let's do that on the next page. That's 2.1. 2.2 is looking at cost of capital. Right, the first form of capital is the debt.
Yeah.
Okay, so let's read it. And let's identify variables. Company can raise the first 400,000 by selling a 20-year 9% semi-annual coupon bond. Right, that's future value.
Yeah.
20 years in. It's semi-annual, so make sure you times it by 2. Coupons are 9% semi-annually. Make sure you divide by 2. Each with a par value of 1,000. Okay, so that's looking at the number of bonds that you're issuing. Okay, so 400 bonds at a par value of 1,000 Rand each. Okay, because similar risk bonds earn rates greater than 9%, the firm must sell the bonds at a discount. See, 980 Rand. So, a discount to par to compensate for the lower coupon rate. Okay, obviously the coupon rate is lower than the market.
Yeah.
Right, then the flotation costs are 3%. That's important. Why? That's a charge that's going to be implemented when selling these bonds in the market.
Okay.
Additional debt in excess of 400,000 will have an after-tax cost of 8.4%. That's additional debt. So there's actually two forms of financing here. There's one, the bonds, and then there's two, additional debts. Okay, so we need to look at both separately. I'm going to look at the easy one first because there's no calculation necessary for it. Any additional capital in excess of 400,000 for the debt will be raised at an after-tax cost of 8.4%. That's stating the obvious. It's important because that's a form of capital. So in terms of debt, there's actually A and there's B.
Okay. So A would be bonds, and B would be debt, would be normal debt.
Yes.
Or loan.
Yeah, okay. So the bonds you have to calculate, and then 1B would be...
The cost is 8.4, would be 8.4, or whatever the...
Yeah, additional debt costs for other forms of debt finance.
Yeah, okay. Okay, so that's pretty straightforward. Then the bond would have, you do your normal PB, PMT, FV, I, and N. So N would be 40, I would be 4.5, present value would be 980, your future value would be 100.
Yeah, but don't forget the flotation costs.
Yeah.
Alright, so there are flotation costs of 3%. We've got 9% of 1,000 is your par, which is your PMT. 980 was the issue price. So 980 times 3%. Okay, less flotation costs.
Can we just go back to the question quickly? Okay, so your payment would be the 9%
of 1,000.
Yeah, so 90 Rand.
No, divide by 2. Don't forget it's semi-annual.
Yeah. Okay. So 4.5. This is the one where we're calculating for I again. So we need to put the present value as a negative, correct?
Yes, that's right. Yeah, we'll work that out now. Let's see what we get first.
Yeah.
980 minus brackets 980 times 3% flotation costs gives you that.
So it's minus 950.6. Okay. So we're calculating for us. So let me do that. Okay, so we got 1,000 is the future value. 950.6 negative is the present value. Your payment is what? The payment would be 45 Rand, wouldn't it?
Yes.
45 would be your payment. And your period would be 40. And I get to 4.779, so 4.8, yeah.
Right, so this is per half year.
Yeah, per half year.
All right. So the yield to maturity for the bond, the quoted rates.
So it would be 9.55 actually, 84878, because your time's about 2 if it's per half year.
Yes.
Okay. Just want to check something quickly.
Right, but that's not the answer. What do you know about debts?
Yeah, I'll tell you now. Is you minus the tax rate.
Exactly.
Okay, cool. So
what is the tax rate in this question? Let's go back and check. What was it? Was it 28 or 29? Okay, they're using 29.
I think so, yeah. Yeah, 29%. So then we would have to calculate what the actual cost of the debt is minus. Okay.
There's the answer.
Okay, and wouldn't you do the tax? Is the 8.4 cent, did it say it was after tax?
The 6,78 is after tax.
Yeah, and but the additional forms of debt, did it say it was after tax?
Yeah, that's what the question said. It was given.
Okay, so that's after tax.
Alright, so that covers the debt part. Now we need to look at the equity.
Okay, cool.
Second form of financing. Let's have a look. What comes first? Okay, the pref shares come first, then the ordinary. So let's look at the pref shares. D Limited is contemplating issuing 10% pref shares, expected to sell at a par value of 80 Rand per share. The cost of issuing and selling the shares is 7 Rand. Okay, so pref shares, remember, are perpetuity type calculations. So payment over the rate, basically.
Yeah, so
okay, if we're working out the rate, we're working out the R.
So PV equals div 1 over R.
Well, yes, if you're looking at the Gordon growth model without the growth, yes.
Yeah.
But
so we'd have a 10% preference share. So 10% of 80 would be, your dividend would be 8 Rand, wouldn't it?
Yeah, we can look at the dividend now. Let's write down the formula first. I'm going to go to the workings, pref shares. I'm just going to write this down. Okay, this is the formula that's in the notes. Okay, so the cost is going to be the dividends.
Equals 10.9589.
The dividend in the question is 10% of 80 Rand.
Yeah. Which is 8 Rand.
And then the net proceeds is
80 Rand minus 7.
Yes.
Which gives you 8 divided by 73. And it gives you 10.98. Okay. Yeah, that's what I got.
And that's the cost. That was it.
Yeah.
That's the cost
How
of
many,
the pref
how many
share.
decimals would you round up to? Would it be acceptable? I mean, would it be 2 decimals or?
It
or would
depends
you
on the
do it like
question
that?
paper. The question paper should tell you to round off to 1, 2, 3, 4 decimals. So unless they actually specifically say here in the question, You could actually round off to whatever you want to, but then you would have to state that you're rounding off to 1 or 2, or I'm just checking now. Do they say anything here? No, see, they don't actually say round off to 1, round off to 2, round off to 3 or 4 decimals. So I would be safe, don't round off too much, rather round off to maybe 3 decimals or 4 decimals, because at least then you've got the exact answer.
Yeah. No, but I'm just saying, like, I mean, if you just round it off, so make that 10.96 or 10.959 or...
Yeah, well, if you do round off, then state that you are rounding off. Then say, I've rounded off to 1 decimal, 2 decimal, 3 decimals, whatever you're using.
No, 100%.
Okay. Yeah, but they don't actually specifically say, so I can't really answer that question. It depends on them.
Okay.
Okay. Alright, I don't round off when I do these workings. I leave the workings as is.
Yeah.
Alright, last one. Form of finance here, ordinary shares. Okay, so if we read this. Retained earnings, 300,000. Notice there is a separate form of financing here.
Yeah.
Okay, so do you need to discuss retained earnings? Definitely, because they said get the costs of all the forms of finance. So even retained earnings is a form of finance, but the cost of retained earnings will be the same as issuing new shares.
Yeah.
Any amount in excess of 300,000 will be raised by issuing new shares. The company's ordinary shares are currently selling for 50 Rand. That's your PV.
Yeah.
It expects to pay a dividend of 4 Rand. That's Div 1 at the end of the coming year. Coming year means the next year, so that is Div 1. Flotation cost for issuing the shares, 4 Rand 90. The dividends are paid on the outstanding shares over the past 6 years are given as follows. Why do they give you this?
Because that's your growth.
Exactly.
So you could use the Gordon growth method, couldn't you?
Yeah, well, you could use the Gordon growth and you would solve for the R, 100%. That's what we're going to be doing.
Okay.
Okay, so let's take that information, let's write it down. First thing I would do here is I'd put a heading and I would discuss the relevance of retained earnings and the issuing of new shares. Because who knows whether they'll give you marks for this or not. Okay, remember it's 25 marks. I think this question was out of 6 or 7 or 8. Can't remember. We'll have to check the mark allocation just now. How much was this out of?
Okay, but doesn't the
8.
The flotation cost have a an impact on the price of the shares though?
Of course it does.
Okay.
Yeah, so, but I'm just talking about theory because there are 2 forms of financing here in terms of ordinary shares. It's ordinary shares and retained earnings.
Yeah.
Right, so the point I'm trying to make is that we don't know what UNISA is going to allocate marks for. Right, something as simple as theory covering the RE, the retained earnings, could carry marks depending on the answers, the memo.
Okay.
Right, so I would discuss theory here relating to the retained earnings and how the costs or the cost of retained earnings is the same as the cost of issuing new shares. Okay, bracket asterisk, it's assumed to be the same.
Yeah.
Right, it's worthwhile to state that, to give that. Okay, so then I would say retained earnings, brackets as a source of finance, okay, the same cost as issuing new shares. And then obviously I would write this as, this was 3. So 3A and then 3B. Just to label the sources of finance.
Okay, but now wouldn't retained earnings be slightly less? I mean, slightly more than the cost of, I suppose, no, because it's still 50 Rand a share.
Yeah, well, retained earnings, you can add more theory. So that's the point I'm trying to make, is that you can write as much as you want to. You can also debate that RE actually has a cost, inverted commas, which is less than the issue
of new
shares.
Because of the flotation costs.
Exactly, because there is a consideration for flotation costs, etc., etc., etc. Alright, so again, that's theory. You can write a whole essay if you want to, just depends on time. But I would definitely talk about retained earnings in the answer, because they're asking you to comment and calculate the cost of all the different forms of finance. Okay. Issuing new shares, now we can do the working. Right, so Gordon growth can be the formula we can use here, so there's nothing wrong with using this, and then just solving for the R. Alright, so let's read the question and let's insert. Currently selling for 50 Rand. Dividend of 4 Rand at the end of the coming year, so that's Div 1. Flotation cost 4 Rand 90. The dividends paid on the outstanding shares over the past year, so we need to work out growth. Okay, so let's insert the 50, the 4 Rand, and the 4 Rand 90.
Okay. Does the 4 Rand 90 comes off the 50?
Yes.
Okay.
Okay, how do we calculate the G? Simple. Future value, present value, N.
Okay. G, future value, present value, N. Solve our. Okay.
Let's see, N. 1, 2, 3, 4, 5 years.
Yeah, cool. Okay. So we've got 5N. We've got
372. 5
is 372 is the present value, eh?
372 is the future value. Present value is 297.
Value, is 297.
Okay, so let's see what we get. Calculate the rates. Brackets. N was 5. Right, you get a rate of 4.60617%.
You have to make one of them negative.
Not all of them negative, just one.
Okay, so every time you're calculating for I, you need to make one of them negative.
Either the PV or the FV, because the calculator will get confused if you don't.
Yeah, because I just need to remember that, because I always end up with a no solution. Okay?
Right, so that's it. That's the growth. Then we can put that in here. So, copy, paste. G now has a value.
Which is
0.04600617. Then you need to do some maths here. Okay, so let's work out what 50 minus 4.9 is. Okay, so that is going to equal, or let's say that multiply by R minus 0.04600617 equals 4. Alright, so multiply out 45.1 R negative 45.1 times 0.04600617.
equals
answer. 4. Let's see what we get. Equals that. Equals 4. Leave the 45.1 R on that side.
Equals
4 plus
2.
Okay,
So
R is this divided by 45.1 gives you that.
times by 100 gives you your percentage.
Right, so that's the percentage, that's the cost of issuing new shares. That's that. And that's it. That was 8 marks.
Cool. It's quite a lot of work for 8 marks.
True, but most of it gets done on the calculator.
Yeah.
Right, have we answered that question? Calculate the company's components cost of capital? Yes, we have. Great. Right, then the last question, 2.3 in this paper, wanted DFL, okay, degree of financial leverage, and they even gave you the formula. So you don't even have to study the equation in the actual exam because it was given. Right, so I'm just going to get that from our notes. It's the same equation. Let's just copy it and then paste the actual formula here. Okay, DFL, there's it, take it, copy, paste. Right, what year do they want? We need to go and check. They say, calculate the company's DFL at the level of EBIT in 2017. And also the breakpoint of equity and debt. Okay, assume interest of 35,000. Alright, so that's what we're required to do, and we're going to then substitute that information into the DFL. So let's work out DFL for 2017. Okay, let's go get the EBIT. Where was it? Let's see.
We worked it out. It was
366000.
Yeah.
Right, divide by, open brackets. EBIT is 366000, less interest given in the question, 35,000. Okay, less, open brackets, a pref div. Were there any preference dividends here?
Yes, there were.
Yes, there was, yeah.
Yes, there was.
Okay, the preference share dividends were based on the preference share. So let's go up and check it. There's it. 10% of?
So it's 8 Rand.
So 8 Rand, exactly.
Yep.
Alright, but now how many pref shares have we issued? Let's go back and check. We need that information. Did they give that to us? Let's see. No, they don't give you the pref shares, hey? They only speak about this, so now we need to work it out then. Okay, so here we go. Management of D Limited maintains this: 60% equity, 25% debt, 15% pref shares. Let's write that down.
Okay.
60, 25, 15. 60, 25, 15. Okay, I'm just going to finish off this and just write down pref div. Okay, times 1 over brackets 1 minus T. We can put that in, 0.29. Close brackets, close brackets, close brackets equals. Right, so obviously the problem comes in here. Work out the pref div. Okay, so they tell us in the question. Total finance? Split?
Is 60, 25, 15.
Yes, split amongst those 3 sources of finance. Okay, so I need to know what is the total finance.
Yeah.
Okay, so let's go get that information. Let's go back and read. Okay, how much do they actually need? Let's check. Okay, it cost the company $300,000 to buy this new machine.
Yeah.
Right, so that's the financing decision. Okay, so we're going to need $300,000 needed to finance the purchase of the new machine. Okay, is that the initial investment though? What else did they give us?
45,000. Is that the...
Oh, they also gave us this, the change in working capital.
Okay.
Okay, and we know that the cost was there and little the depreciation. Okay, so now we need to use that information. Right, so this is actually going to be using, we need to use the formula for initial investment.
Yeah.
Okay, so we need to know how much funding they're going to require. That requires us to do a calculation. So now we need to go back to our notes and we need to copy the structure to work out initial investments. So let's get that. Where is it? Here's it. Okay, so then I copy and paste this. And then I need to do a calculation here. Right, so the install cost of the new machine was just $300,000. There was no installation costs.
Yeah.
Right, after tax proceeds of the sale of the old, we need to look at that. Okay, where's the old machine? Here's it. The old machine cost $200,000 2 years ago. That was the cost 2 years ago, and can be sold for $100 before tax. Okay, the lifespan of the old machine was originally 6 years, and depreciation is calculated on a straight line basis. Okay, 6 years. The machine is 2 years old, and we need to calculate the tax on the sale. $100,000 is the proceeds. $200,000 is the cost. Let's do the working here. Proceeds $100,000. Tax on the sale. Let's work it out. Carrying value of the old assets is cost less accumulated depreciation.
Yeah.
Cost was $200,000 2 years ago. Minus accumulated depreciation. 200,000 divided by 6 years times 2 years, because that's the number of years that you've got.
Yeah.
Gives me that. Okay, so that gives me the carrying value. Carrying value of the asset is 133. I'm selling the asset at 100,000. Okay, so you're selling at a loss of 33,333. Times that by 29% gives you the tax benefits.
Okay. Didn't they say that you must say that the tax was 35,000?
No, that was interest. That's something totally different.
Okay.
Okay, so the tax benefit is 9,666, so that's going to be added here.
Okay.
This plus that gives me the after-tax proceeds of the old. Okay, so now I can work that out. Oh, change in working capital, I need to look at that. Okay, so let's put a bracket here for the change in working capital. Let's go and see what we've got. Okay, so where's my... there's it. As a result of purchasing the new machine, cash is going to increase by 20,000. Accounts receivable, 40,000. So we need to look at the change in working capital. So I'm going to put
60,000.
Change in net working capital equals plus 20 for cash, plus 60.
For inventory. Or accounts receivable plus there was inventory.
Oh, plus 40 and then plus 60.
Yeah, plus 40 plus 60. Minus 50 and then minus 10. So it's actually plus 20.
Minus 50 plus 10. Let's just check that.
Minus 50 minus 10.
Yeah,
minus
increase.
Minus 10.
So an increase in accounts payable will be a minus. Accruals will be a minus. Yeah, so that's fine.
Yeah.
Okay,
Yeah.
and then we just work out whatever this is. Okay, gives us a plus 60.
Yeah.
All right, so initial investments.
Oh, yeah. Plus 60. That's right, yeah.
Is this minus that plus this gives me that answer.
Okay.
Right, so now this is the amount of finance that's needed.
Yeah.
Okay, let's write that down up here. Right, and then obviously we want to know how much is the preference share capital. Well, that's simple. Preference share capital is 15% of the 250333.333.
Yeah.
Right, and if I times it by 15%, I get that answer. Right, so now I know what the preference share capital is. That's very important because that is what I'm going to put into my formula. 37550. Okay, so let's copy paste. 37550.
Okay. So we have to
DFL equals 1.31.
Okay.
That's the DFL. Okay, makes sense.
Yeah.
Alright, let's check if we left anything out. Let's go back and check the question. Calculate the company's degree of financial leverage. Oh, we also need to do two things. Also, calculate the breakpoint of equity and debt. Okay, so that means we need to expand here. Okay, so how much is preference share capital? How much is debt? And how much is ordinary share capital? Okay, or equity. Okay, so obviously we're just going to take 25% is debt, 60% is equity. Right, so this times 25% gives me that. This times 60% gives me that. Okay, so now we need the breakpoints. So I'm going to take those figures. I'm actually going to do the breakpoints just on the right here.
Okay.
Okay, so breakpoints. Okay, the preference share capital breakpoint equals, right, the 37550 divide by the 15%, 0.15 equals. hold on. That's not right. There's something wrong with the working. Let me just think now. Breakpoint, breakpoint, breakpoint. Breakpoint, we normally calculate. It's the total share capital divided by the percentage. Oh, that should be right. Let me just double check that. I just want to check that in a previous question.
Yeah, cool. That's exactly what you're doing is right.
Okay, perfect. Yeah, so I just wanted to confirm that, but now you've confirmed it, so that's great. Yeah, so the breakpoint is just the source of funding, the amount, divided by the value.
Yes,
so yeah.
divided by value,
Okay,
yeah.
so then let's write down debt here. Debt would be 62583.333 less the 25%.
Yeah.
Okay, it's going to be the same amount actually, yeah. Because it's a percentage of, so if we're grossing it up, it's going to be the final figure anyway. Yeah, so it's a very strange question. Because they've asked you about breakpoints, but the funding doesn't change. So the breakpoint would actually be that. Because when you reach that level, you're then going to be, oh, hold on a sec. I see where I've made the mistake. Okay, the breakpoint is looking at how much funding you have available. Sorry.
Okay.
It's the total amount of funding available.
Okay.
Right, so how much preference share capital do I have available? Let's go and check. Preference share capital. Do they say there's a limit here? No, there's no limit on the preference share capital. Do you see that?
Yeah.
Okay, so there wouldn't be a breakpoint for the preference share capital. So preference share capital, it's question mark here. Asterisk, no amount of preference share capital specified.
Yeah.
Okay. Can I do that for the debt? Yes, I can. Right. In the debt, they said that the first 400,000.
Yeah.
Okay, is the bonds. So now we can put that in. So the break point for debt bonds, debt bracket bonds, the break point for the bonds would be 400,000 divided by the 25%. That's how you do it. Okay. That's the right way of doing it. Right, 1.6 million. Okay, going back to the question. You've got ordinary shares. You've got retained earnings of 300,000. Okay, so the retained earnings will have a break point.
Yeah.
So equity break point. Bracket the RE, retained earnings. Okay, the break point for retained earnings would be 300,000 divided by 60%. Which is 500,000. Okay, so now we've answered that question as well. Right, we've included the breakpoints for debt and equity.
Cool.
Let's go back and see. Was that it? Breakpoints of debt and equity. Equity done, debt done. Now we've completed it. And that was May, June 2017, the second question.